Why did Canada cut rates now? They've dropped the rate again. Good for your debt, bad for your grocery bill. If you got a mortgage, credit card, or even just a saving account, this move touches you. Here is what's going on. The Bank of Canada just lowered its key interest rate to 2.5%, the lowest in 3 years. This is no small tweak. It affects how much you pay every month, how fast inflation eats your groceries, how expensive your debt is, how much your savings earn or lose. Stick around because by the end of this, you are going to see what side of the ledger you land on. Are you about to get a break or get squeezed? What the BOC just did and why. Let me break down what actually happened. On September 17th, 2025, the Bank of Canada cut its policy rate by 25 basis points, that's 0.25%, to 2.5%. This is the first cut in 6 months. They've been pausing for a while. They did it because inflation, while still high in places, core inflation pressure is diminishing, especially with some recent tariff removals. Also, job markets are weakening. In short, Bank of Canada sees risk in doing nothing. It wants to avoid slipping into recession or letting unemployment spiral, while keeping inflation somewhat under control. What 2.5% means, technically and emotionally. Okay, so what does 2.5% actually mean? And what doesn't it mean when it shows up in your life? Okay, so what it does. For people with variable rate mortgages, your interest costs go down. Payments drop somewhat. More of your money can go towards reducing principal instead of just interest. For debt like line of credit, credit cards, if variable, personal loans, less interest pressure, potentially lighter monthly payments, or more breathing room if you are servicing debt. For homeowners, renewing variable components, refinancing, you might benefit. What it does not. If you have a fixed rate mortgage, especially the famous 5-year fixed, which many Canadians do, your rate was locked long ago. That does not change until renewal. You don't see benefit until then. It does not instantly fix inflation. Grocery prices, gas, utilities, many are sticky. They lag. Even if the rate drops, things already baked in don't reverse overnight. It does not erase past debt. If you owe a lot, your interest burden might go down going forward, but what you already paid is already gone. Before we go any further, please like, subscribe, and share this video with your friends. Subscribing to my channel is not going to cost you anything, but it does help me big time. Thank you. Now back to our topic. Why Bank of Canada felt pressured? The economic backdrop. You want context because without understanding why they cut, you cannot tell whether this helps you or leaves you hanging. Here is what's pushing Bank of Canada's hand. Weak job market, employers are cutting, hiring is sluggish, unemployment in August hit levels not seen in years, slowing economy, growth contraction. Q2 GDP shrank around 1.5% to 1.6%, exports down heavily because of US tariffs and trade friction, businesses are pulling back investment, inflation easing, especially core inflation. It's still above target in some measures, but the worst seems over. Tariff removals from US goods have helped reduce some input cost inflation. External risks, US trade policy, global economic, oil price weakness. Canada is not immune. Tariffs affect exports and supply chain. So, Bank of Canada cut now because waiting seemed riskier. unemployment rising, output dropping, consumer and business confidence weakening. They have to balance too much tightening and recession, too loose and inflation rebounds. How it hurts you. Debt, payment, mortgages. Now, let's talk pain points. Where you might feel this outside of news headlines, if you have variable rate payments, your monthly payments might reduce. Good. More cash in your pocket. But only if your lender allows it. If you are locked in fixed, you wait. Credit cards, line of credits, any variable interest debt likely becomes slightly cheaper. But the difference may be small unless you have large balances, mortgage renewals, and refinancing. This cut might help if you are renewing a variable portion or looking to refinance variable rate debts. Not helpful if you locked in something fixed years ago. Savings and investments. Yeah, here is the downside. Lower interest rates often mean lower returns for saving accounts, GICs, high interest savings, and others. If you depend on interest income, this sucks. Rates you thought were safe might look less generous. Housing market and mortgage stress test. Easier rates can trigger more demand for houses. If demand picks up, house prices might push higher again in hot markets. That's great if you own. Painful if you are trying to buy. Inflation creep. Sometimes lower rates can stoke inflation again if demand picks up and supply is constrained. So, while you might get relief on debt, your grocery or gas bill could still rise. How it helps? Let me be fair. There are real benefits here for many folks. Breathing room, lower interest rates on variable debt mean more cash for groceries, bills, family. That relief matters. Incentive to spend or invest. Lower borrowing cost can encourage people to buy big ticket items, cars, home improvements, or support small businesses. That can circulate money in the economy. Mortgage holders nearing renewal might find better deals or more favorable variable rates options ahead. Lower rates could help housing affordability if builders or borrowers respond. Mortgages become cheaper, demand moderates, construction picks up. For those with large debts, credit obligations lighten, maybe pay off debt quicker with lower interest overhead. For the economy broadly, smoother slowdown versus collapse. If Bank of Canada times it right, it eases the landing rather than letting the blow hit hard. Risks, trade-offs, and what might go wrong. Nothing is free. Every cut has trade-offs. Here is where this could blow back at you or at others. If the rate is too low for too long, inflation might rise again, especially if external shocks, oil, trade disruptions, send input costs up. Savers lose. People living off interest income, retirees, people depending on safe fixed income investments get squeezed. Real estate surge. Cheaper borrowing might fuel house price inflation in already red hot markets. That worsens affordability for new buyers. Debt risk. People take on more debt believing it's cheap. But when rates go up again, and they will someday, payments might balloon. Banks and lenders might tighten other terms, mortgage stress tests, down payments, credit criteria to cover their risk. So, even if rates drop, qualification might still be hard. Region specific risks. In provinces with weak economies, low resource demand, high debt, cut might help less or later. the benefit won't be evenly distributed. Currency and import risk. Rate cuts can weaken the dollar as markets adjust. Importing goods can get more expensive, which pushes some inflation back. For fixed rate holders, no benefit until renewal. That's a large chunk of homeowners. Many won't notice for a while. What you should do or watch for. Here's where you get tactical because knowing what to do matters. Review your mortgage. If you have variable rate debt, check if refinancing or switching to variable makes sense. Talk to your lender. See if you can lock in something ahead of any curve up. Budget with caution. Cheaper debt payments help today. Groceries, gas, utilities might still creep up. Don't assume full cost relief across the board. If you are a saver, explore other options. Some investments may outperform savings accounts. Consider other investment options. Talk to your financial advisor. Watch inflation reports, CPI, core inflation, food prices. If they reverse and show upward pressure, Bank of Canada might stop cuts or even hike. Monitor your local housing market. In your city, what's happening with mortgage rates, home prices? Big cities often respond differently than smaller towns. Stay aware of policy shifts, tariffs, trade negotiations, supply chain disruptions. These outside forces feed into inflation and borrowing costs. Bank of Canada watches them very closely. What this means politically and for you long term. Here is my read. This rate cut is necessary. It's overdue. Canada was showing cracks, job loss, weak exports, fading growth. The BOC had little choice, but it's also risky. It is a gamble. Ease just enough without letting inflation sneak back. It is steering a ship in rough waters. If you play it smart, you will get some relief. If you sleep through it, you might get bit. Politically, this matters. Voters will notice if this improves cost of living, mortgage burdens, or if it fails and people feel like they got tricked. Long term, you want stability. You don't want another inflation spike, another rate tightening that kills growth. You want predictability in your bills, housing, debt. For your wallet, what you experience will depend on where you live, what kind of debt you carry, whether you own or rent, fixed versus variable rates. Some will get breaks, others will still feel squeezed. But overall, this cut tilts things slightly in favor of debt carriers, less so for savers. Bottom line, Bank of Canada just cut rates to 2.5%. Good move if you owe money. Mixed bag if you live off savings or fixed income. If you have got debt, you might breathe easier in the short term. If you are buying, maybe you get better offers. But don't expect everything to get cheaper overnight. Cost pressure does not reverse in one move. What I want you to do, drop a comment. What kind of debt do you carry? Mortgage, credit line, credit card. Are you already seeing relief? Share this video with someone else carrying debt. Let's see how this hits real people. Hit like and subscribe if you want updates because another cut might be coming. Thanks for sticking with me. Let's watch what BOC does next because it's your wallet that will tell the truth. Thank you so much for watching and I'll see you in my next video.